Good afternoon. We're here today to talk about social impact investing in the US and around the world. We're really lucky to be joined by some terrific investors who've been pioneers in the education sector. On my left, Phil Alphonse, next to him, Victor Hugh, and then, of course, the inimitable Michael Moe. Why don't we start off with a round of introductions? We'd love to have folks talk a little bit about your background and how you ended up working in the education sector. And Phil, why don't we start with you?
So the Vistria Group, we today manage about $6.5 billion in capital. 40% of our capital is going to be focused on investing in education. We invest across the full continuum, so early learning all the way through workforce development. We are an impact fund, and so for us, we're both trying to achieve top decile performance and also track key statistics that we think are important. And for us, those aren't sort of binary. We fully believe that the impact statistics that we track really create long-term franchise value. So that's sort of a foundational philosophy for the firm. How I got involved in the space is probably a longer, more boring, conversation.
Down in the bar this evening.
Yeah, but I've been doing investing in the space since the early 2000s. I was with another fund. I was with them for 10 years, also investing in education. And after a few years, I liked what I was doing, and I decided to stick with it.
That's great.
Yep.
Victor, you've launched one of the newer funds, but have been around for a while. Tell folks about your background.
Thank you, John. I'm Victor Hugh. I'm the co-founder and managing partner of Lumos Capital Group. As John said, we're fairly new. Got started in the second half of 2019 and raised our fund actually through the pandemic, raised a couple $100 million to do growth stage investing in education technology, human capital development. We are looking to build a fairly concentrated portfolio across K-12, higher education, alternative higher education, workforce development, corporate learning. We do invest globally with heavier focus on the North American markets, but already have a number of portfolio companies that are overseas. In terms of my own connection to the education space, have been around the sector for a very long time, really due to some family background. It goes back many generations in my family. So my grandmother was the first female president of the main teachers college in Taiwan, where I'm from. I was born in Taipei, Taiwan. I grew up in Asia and Southern Africa, and experienced a lot of different education systems, mostly followed the education space in a nonprofit capacity up until when I was at Goldman Sachs many years ago. Helped to start our education technology and human capital knowledge services group in the 2000s. One of the first people I met was my friend Michael Moe, who had been in the space even longer than myself. And there worked leading that group through 2017, did about $50 billion of transactions in the space globally across financing, advising, M&A, and debt. And then invested for a couple of years with the family office before launching Lumos Capital Group in 2019.
And Michael, you've really helped to create the entire field of education sector investing, and you've also embraced the moniker of impact. Maybe you could talk to us about that background and that evolution.
Yeah, thank you. So the background was literally over 25 years ago. What really got me interested, just in the context of my day job of being a research analyst. So I saw a lot of different companies, and we happened to go to a school company in Baltimore that was managing public schools. And so I went to some of the schools in Baltimore, and I literally couldn't believe that schools in the United States existed like I visited. I mean, I'm not exaggerating. There were dead animals in the courtyard that the neighbors had shot for sport. They didn't have partitions in the bathrooms. And you say, why are half the kids dropping out and don't finish? And so that just got my interest. Like I said, there's got to be a solution here through entrepreneurship and involvement. And so that's been a journey for the last 25 years. And as it relates to impact, I think what we've always viewed the investments we make in the education sector as a natural alignment. The companies that are going to have the most educational impact are going to create the best financial returns in our view. So we're looking for scale impact, and that's how we think we can have the greatest, do the best for our partners, but do the best for society.
I do think there's, my own personal background is I do think there's a benefit to embracing the moniker of impact. I had the opportunity to call on Michael and Deborah back when you were at Think Equity in the early 2000s as I was first investing in the education sector for DB Capital, and spent a couple of decades investing in sectors like education and healthcare, but really came to believe that there's not just a science, not just an art, but also a science to driving good outcomes. And if you really put those outcomes front and center and require yourself to put the impact front and center, you're going to do better, as an investor commercially as well, which is why I joined the Rise Fund back in 2017. Phil, maybe you can comment, though, a little bit about some of the tension, because there's a lot of folks who don't necessarily believe, there's some folks who don't necessarily believe if you have a for-profit ed tech company that it'll have efficacy and outcomes. There are folks who don't necessarily believe that if you're a social impact fund, you'll have returns. And I think Vistria itself has kind of had a little bit of concern about whether the social impact monitor would have an impact on folks' view of you commercially. So maybe you could say more about that.
Yeah, I mean, we launched the firm back in 2012, and we had a charter that articulated what was important to us, and we self-identified as an impact fund, but we really did not advertise it. We did not advertise it broadly. And it's for a very basic reason. I mean, we're African-American owned, and you walk in the door to LPs and you start marketing yourself as an impact fund, you're going to get a lot of no's, right? And impact back then was not synonymous with top decile performance. So when we started the firm, impact was something that was really internal to the partnership. And it was sort of a foundational ideas for us and what we wanted to track in the portfolio and what was important for us. And we did track it. So we could actually go back to the early days of what was important and why we wanted to do these deals. And then as we got through as we got into the third fund, impact became higher priority, I think, for the LP community. And we got inbounds from some of our existing investors to talk more about it and to share more about the tracking. And we started to be more explicit about our positioning as an impact investor. So.
Well, and hopefully that's an encouraging sign. We certainly had to sell through the resistance to social impact when we raised the Rise Fund in 2017. Victor, you've raised your fund a little bit more recently. Was it wind in the sails or a headwind to identify as impact?
Yeah, for us, what we love about this sector is that we do feel that there are a disproportionate number of founders and entrepreneurs who are mission-driven, who really, really care about overall outcomes. And I agree with Michael. In our experience, the companies that endure over a longer period of time are those that place the well-being of their customers and the ultimate outcomes that they can achieve for them first. And when they do well by them, they end up creating longer-term, enduring financial success. And that is something that we do very much see play out over the long run. Sometimes it takes a little bit longer for those truths to ultimately bear out. For us, we were pretty upfront with our own sort of marketing around how we approached it. We had a specific framework, and we certainly are not seeking anything but sort of market-based returns, and it's really important to our LPs. It turns out about half of our LPs were very much commercial LPs focused on the market opportunity, and about half had a ESG, double bottom line, social impact-oriented framework. And so it ended up crossing over very nicely, and I think that we find that this sector is one where, if you're discerning, you can certainly find both. I'm not one who subscribes to the fact that companies that in this sector are automatically positive impact. I think there are plenty of sort of perverse incentives in the marketplace and companies that do take advantage of them. There are plenty of loopholes. et cetera. But by and large, as I said earlier, we are comforted by the fact that most of the companies that we see are started for the right reasons.
Well, and maybe we've referenced social impact a handful of times now. Maybe we should define what we mean by it. So, Michael, when you describe yourself as an impact investor in addition to an education sector investor, what's special about impact? What does that mean when you say you're investing around social impact?
It means we have a fundamental philosophy. We can get everything we want if we help enough people get what they want. And so we look at social impact as how can we have the greatest impact and really scale impact for society. And so, we've got and I do believe that we're having a convergence going on where the best businesses of tomorrow are going to combine the ambition of a for-profit with the heart of a not-for-profit. And that social impact is going to be, kind of core to the ability not only to compete in the marketplace, but to attract the best people and how the community embraces businesses.
That's great. And Victor, how do you all define social impact? What's special about social impact?
So for us, we have a framework that we apply for every investment opportunity. We bake it into the overall investment process from sourcing all the way through to post-investment value add and execution. But we really anchor it around three main pillars, focused really around quality of the underlying product and whether it is better than or on par with or less than comparables in the marketplace. We think about access, whether it is creating better access to superior educational resources for a larger number of people. And then we think about equity in terms of the overall market structure in which a specific company product exists. And I think that there are enormous differences and variables to consider across different end markets when looking certainly geographically, from region to region, from country to country, and then certainly across the end markets, across early childhood, K-12, higher education, corporate, et cetera. A lot of it does also depend on the business model and the ultimate go-to-market, whether it's a B2B or B2C company or a B2B2C or B2C2B. We're seeing more and more variations around these business models, but we take those into account and try and anchor the analyses around those three areas.
And Phil, how does Vistria define social impact?
Yeah, the first thing, I think UN has published principles around responsible investing, and we've executed that, and we are signatories to that charter, and we did that back when we founded the firm. And then secondly, it's about accountability. So it's not going to be perfect because I think we're all trying to define it, but we've committed to continuing to do better. And so we track specific statistics related to outcomes tied to the services that we're performing in the portfolio, test completion rates, employment rates, et cetera. We also track specific statistics related to human capital, employee engagement, DEI statistics. And if you don't track it, you can't improve. So for us, we start with accountability and measurement, and it's not going to be perfect, but we're going to continue to refine it as we go.
And who sees those statistics? To whom do you report it?
Anyone who wants to see it, but it's LPs, so our investors get it, our operating partners get it, and our CEOs get it.
And I want to plus one on the just the notion of sort of constructive accountability in this space, because I do think that the overall moniker can be utilized, I think in a way that doesn't necessarily create authenticity. So for us, we have an impact advisory council consisting today mostly of our LPs, and we meet with them regularly, really to have sort of accountability for our team, also to incorporate best practices across the market, but really to hold ourselves accountable to the things that we said we wanted to do. And as Phil said, to actually be able to present metrics and measurements and really force us to do the things, particularly post-investment, that we said we wanted to do going into the investment, and be able to report on that to our LPs. I think that ends up being incredibly important.
we agree that measurement and reporting is a pretty helpful kind of tool for alignment and for driving what you're actually going to manage. And I referenced it earlier, but at the RISE Fund, we're required by our charter to look at the third-party evidence that describes the impact and outcomes of any company in which we're investing, and to actually build a social impact valuation model side by side with the financial model, which has some areas of subjectivity to it, but the process of going through it and forcing yourself to look at the research ends up being a pretty constructive way to think about quality, and then to really kind of lash yourself to the mast. And it changes how we manage as board members. We lean into the data gathering and the data reporting and the data analysis, and it helps then our management teams as they make choices. We should talk a little bit about how this plays out on a global stage. I spent the better part of 2 decades investing entirely in the mid-market in the US in controlled deals. And then I walked into my first investment committee meeting at RISE, and we were talking about an ed tech company in the US and a dairy farm in India. So it was a pretty broad set of investments we were considering, which is a challenge. Michael, you're investing all around the world, and you've been doing a lot of work in Asia in addition to the United States. What are the challenges of trying to do education sector investing on a global stage?
So I don't know if anybody has heard about China, but that probably is Exhibit A of some of the challenges that one can face in investing outside the United States. And so, we're eyes wide open. I mean, we have tremendous amount of interest in company. What's our firm GSV? Nobody ever talks about the name. It's Global Silicon Valley, because we believe that while Silicon Valley is the heart of innovation, that mindset of entrepreneurship and innovation is spreading throughout the world at a really rapid clip. And so, given that the U.S. has 6% of the population, increasingly opportunities are going to be found in many different places outside the United States. And Asia specifically, and Victor really is the expert here, is mind-blowing in terms of not only just the demographics and the rise in the middle class, but the emphasis on education in Asia. But just statistically, they spend seven times more on family and discretionary education than the U.S. So everybody just understands that is the ticket for opportunity. And so the amount of innovation and entrepreneurship that's going on overseas is really exciting. But it's not for amateurs, I guess.
The faint of heart.
Yeah.
Victor, how do you take on the global challenge of ed sector investing?
I think that, as Michael said, the opportunities around the world are extremely exciting because the growth trends that we're seeing in some markets, driven by demographics, driven by culture and spend, driven by certain countries that are just in a specific part of a growth cycle today, means that there's an abundance of opportunities. The challenge, of course, is there's always a knowledge gap. If you're not there on the ground. For us, we do have a high bar around it. We are looking for multiple areas of connectivity. We're looking for some competitive advantage in terms of a knowledge base, in terms of relationships that we might have with the board or the management team. In our most recent investment, which is a Paris-based company called Open Classrooms, having worked really extensively with many members of the board in their prior lives on taking some of their companies public or selling their businesses, et cetera, and building a long-term relationship was pretty foundational for us. There, it's a good example of in some of these markets. We're extremely cognizant of the differences in the regulatory approach and regulatory environment, because that may end up, being, the difference between a winning investment and not. But sometimes the regulatory frameworks can be extremely helpful too. And if you build in the right way, they can actually create really strong moats, and they can create really strong tailwinds. In France, for example, the fact that they have apprenticeship levies, and they have certain funding that is committed on a very long-term basis across enterprises, across some of their government agencies for reskilling and retraining the unemployed for apprenticeships. Those are things that are actually much more mature in some of these markets in Western Europe than they are here in the U.S. Even though the U.S. has very strong underlying growth trends now for some of these areas too under the Biden administration. But having region or country-specific knowledge and then feet on the ground end up being really important to us as well as particular deal angles.
I'm just going to add to my answer. So, for example, in China, which we hadn't made an investment in, I went there 20 times in the 3 years before COVID, and so what I know about China is the more I went, the less I knew. But I think with all these markets, how we try to focus is what we believe is you don't need to know everybody, you just need to know the right people. And so we focus very hard to figure out who the right people are in these markets so we can really have a partnership.
Why don't we stay on China for a moment? Folks have probably seen the headlines, but maybe, Michael, you can sum up some of the regulatory changes that have recently happened, and what do you think is driving, what's behind those changes?
Well, yeah, for people that hadn't seen, effectively China banned for-profit tutoring in their country, and we'd been following that situation for a while. And what we thought would ultimately happen, and what the TALs, the New Orientals thought was going to happen, was it was actually going to be a positive thing long term. It was going to weed out some of the bad actors and have the best people thrive. Well, they outlawed the whole industry. I actually think today, because everybody is it's just such uncertainty, I think today is the time where there's going to be incredible opportunity to invest in long-term relationships and potentially opportunities there, but you got to be very careful.
I'll just add to that to say that I think that a lot of the impetus for the regulation is at least the stated impetus appears to be sort of well-meaning, really to reduce inequality, access to education. As Michael said, people spend an enormous amount on after-school tutoring. It does contribute to parental anxiety, and to a certain degree, it may sort of exacerbate some inequalities, et cetera. And then there was obviously an enormous influx of capital that has come into the space over the course of the last 7 to 8 years, really over the last decade plus, but concentrated in the last 5 to 6 years that has lifted the values of some of these businesses to tens of billions of dollars. Now, what the government has done has effectively wiped out the industry, reduced the value of these businesses by well over 90% in a matter of days. Underlying, I think the subtext around it certainly is, number one, that I think the cost of education has been cited by parents as a reason not to have a second child or a third child. And as China thinks long-term, 20, 30 years out, the demographic motivators for them are extremely important. They really want to encourage a higher birth rate. Second of all, the K-12 system and the after-school tutoring space had gotten so big. TALs and New Orientals of the world literally were enrolling millions of students, almost a parallel K-12 ecosystem next to the official system. And as we know, the CCP has really embarked on a strategy of consolidation and control around all industries that get too large and influential, et cetera. And then there's always the issue of the amount of content coming from overseas, the globalization, which is really a incredible trend in the education space, but the globalization, including, for example, US-based teachers teaching Chinese students English, in an after-school tutoring capacity, that people were concerned about some of the content that was being raised in the dialogue, et cetera. And so there's a lot of subtext underneath it. I don't think, however, that any of the demand is going to go away. Like, you might have quashed the supply, but the underlying parental anxiety is actually driven by the fundamental structure of the K-12 system. It's a brutal competitive system, and access to college is ultimately determined by one exam called the Gaokao, the college entrance exam, which people spend half a dozen years preparing for all of their after-school hours sort of committed to. And there's a limited number of high-quality college seats. And if that underlying system is not reformed, the anxiety around children's performance is not going to go away, because in China, you don't invest in your 401k, you invest in your kids. They're your retirement. And they end up, and then that really is like, and you think about it, it's not just the parents investing, it's the two sets of grandparents. They're all investing in one kid. And that's what has driven like the massive sort of average selling prices for some of these transactions in the education space over time, because the culture of supporting your parents when they get older, that really is parents' sort of retirement plans. And so you can only imagine that the wealthy families actually are just rotating their capital to other sources. I think there's going to be a massive black market of a shadow tutoring system that sort of arises out of this.
I'm going to go home and point out to my daughter that she's my 401k. So we've been speaking a lot about investing. There's my wife right now. We've been speaking about investing. Let's talk about some of the companies in which we invest. Phil, why don't you tell folks about one of your recent investments and what got you excited about it?
Yeah. So one of our most recent investments is a company called Edmentum. We've had an active thesis around digital curriculum. Actually, even before COVID hit, there's just a lot of really solid secular tailwinds that support further adoption of technology, increasing RFPs for kind of assessments and other solutions that are being used in the classroom. Some incremental share that the supplemental providers are taking from the incumbent, sort of publishing community. With COVID, many of those trends have been accelerated, and we got the deal done back in December. We think there's a really strong opportunity to consolidate the digital curriculum market. We recently acquired Apex Learning as part of that investment. We see more opportunity in that space. And most importantly, I think we want to be partners to school districts in this environment and be part of the solution. So we see a lot of tailwinds and a lot of opportunity to have kind of the double bottom line.
Yeah, I would think Apex is seeing a pretty big demand for credit recovery as folks are trying to get back into school, but is that right?
Yeah. And this is the first inning, right, of the return. So, and it's not just credit recovery. You have a whole host of families now that are likely to opt for alternative school programming. And historically, the public schools have ceded that opportunity to other providers, and we think increasingly they're going to want to keep those families in the network, and that'll be another opportunity, I think, for companies like Apex and Edmentum.
Yeah. And Victor, Lumos invested in IronHack. Do you want to tell folks about that company?
Sure. So we led a $20 million round in IronHack some months ago. It's a company that's actually co-headquartered across Madrid and Miami, but most of their business is in Western Europe. And we were excited about this business because we've been looking at the alternative higher education category for a long time. We'd previously led investment in Trilogy Education a couple years back. And we'd seen the rise of this category here in the U.S. in a really significant way, but much of the rest of the world was still lagging in this area. IronHack had gone out in a really capital-efficient, bootstrapped way and created an incredible brand in alternative higher education across now 9 different markets across Western Europe and Northern LATAM. And what got us really excited about it is, number one, the founders' sort of commitment to outcomes and transparency. So they report on the outcomes in a way that we just found very authentic and credible. They submit themselves to sort of third-party audits, by PwC. They publish everything very transparently, and that commitment to us was an important one. I think second is they did provide really outstanding employment outcomes for a group of students who are incredibly diverse. And so, here in the U.S., for example, well over 50% of their students are Black or Hispanic. and they have some well over 40% sort of women student enrollments relative to industry averages of closer to 25%. And so their focus on diversity and their outcomes were things that were really attractive to us. They've operated just in this, as I said, very bootstrapped, capital efficient way, raised very little capital over time, and gotten to actually reasonable scale. And we just found like these are folks that we could partner with over the long term. So that's what got us excited about Ironhack.
Glad to hear that they're committed to the workforce outcomes, which I find very difficult to sort out in that particular sector, right? Because there's lots of claims about the workforce outcomes. Michael, what are the angles that you look for in an investment, and how did that lead to one of your recent investments?
Well, the company that I love to share about that isn't a recent investment, we invested a while ago, but that Coursera, which went public 6 months ago. Well, I think Coursera is such a great example of how you create the alignment both between impact and financial returns. Coursera has 87 million students on its platform from around the world. 82 million of them don't pay a dime for having access to some of the best instructors from the best universities in the world. So all this is free and providing incredible access, and the network effects that get created from that have been just gigantic. And the stories of people's lives being literally transformed through that is truly inspiring. And now it has a market cap of about $5 billion. And so it's been really amazing to watch what they've been able to accomplish.
Coursera is a really great success story, and certainly creates a benchmark for the sector. We do want to leave a few minutes for questions, so if folks in the audience have questions, we can take a couple of them now. Yes.
Thank you, that's very inspiring. I wanted to ask you, do you invest outside of the region and markets you use? For example, I'm from the MENA region, and we speak to a lot of investors from North America that say, we don't know that region, and so we prefer not to invest there. How do you feel about that? Is that something that's changing?
So we have invested in MENA. MENA, for those that don't know what that stands for, is the Middle East and North Africa. We're actually putting an office in Abu Dhabi because we're such a believer in the future of that region. And it so happens that Abu Dhabi is a 3-hour flight to Mumbai. It's 4 hours to West Africa. It's 3 hours to Tel Aviv. So it's really well geographically situated as well. So no, we're very bullish, and obviously, again, it's just like Asia in terms of the emphasis on education. They're crazy about education in MENA, for sure.
And Victor, you have pretty extensive experience working in that part of the world as well, right?
Yes, I think that the underlying needs around human capital development and reskilling and retraining are extremely strong there. And then they've historically also had a very, very robust private K-12 education market as well. And so I think there are some really attractive features of those markets. We certainly have considered investments in those regions as well.
Other questions? Sure. The question was about speaking about smaller companies as they scale up and get bigger, as opposed to focusing on some of the larger companies. There is a reality to the size of the fund does have an impact on how small you are able to go, just because of the number of investments that you can sort of possibly manage. So I've, in my own experience, have gone from larger funds, like where I am now, to much smaller funds, including when I was at Bridges Ventures, where we would invest in companies that only had, $8 or $9 million in revenue. Now the companies we invest in will have more, 50, 60, 70, $80 million in revenue. So it is different based on the structure of the funds. I don't know. In my experience, it's a little bit similar in terms of how you develop the themes that are going to work and, prospect for the opportunities, and then you want to find, those companies that have good macro tailwinds and management teams that can scale up. Human capital is still what drives the education sector, and so finding teams that you can partner with and scale up. I don't know, Phil, maybe you can also comment on that because you've worked at funds of different sizes. How do you describe the challenge of a smaller investment versus a larger investment, and what's similar or different?
Yeah, there's a whole dynamic too of stage, kind of stage as well. And we are also, just given our mandate, we're investing in companies that are typically 10 million of EBITDA and up. We do have examples in the portfolio of companies that have grown from kind of the lower end of the range of our investment range to much larger. When you ask about the challenges, I mean, they're multiple, but the box that we play in, we typically don't take technology risk. We're not taking enterprise risk. I'd say the biggest benefit of starting kind of where we start is talent. And I just, from having done smaller deals, kind of sub 10 million, and doing stuff that's a little bit larger now, you can get some great ideas, but the gating factor that I see pretty consistently across the board is talent. Operating, we lean heavily on our operating partners. Our model is to lean heavily on operational excellence. We do have a kind of an operational playbook that we use pretty heavily. And there's just a big difference between the type of people that you can recruit in when you've got a 30, 40 million EBITDA business versus 5. I think when you're dealing with a really exciting startup, that may be less of an issue. But for more traditional kind of PE style businesses, there is just a big difference, and the outcomes can be exponential, right, with the difference in talent.
Go ahead, Michael.
I was just going to say, so we invest in everything from an entrepreneur and a business plan and a dog. I think we've written this checks as small as $250,000 to investing a little bit. How much should we ultimately put in Coursera? Something like over probably $50 million when you add all the SPVs and the funds. So we do a lot of small investments, and we hope they grow to success and put more money in them.
The one thing I'll add too is that one pattern in this sector that I have observed over time is that there are lots of companies that actually take a long time to incubate in this space. They bootstrap for a while. They're not on a rocket ship from day one, and this sector is complex. It's complex to get outcomes. Sometimes you have to create a whole ecosystem around it. This business that we just invested in, Open Classrooms in France, it really got started in the early days of the web, in a little after 2000. It was a project by 2 teenage boys, the eventual co-founders of this company, who wanted to create a site for teaching coding for free. And they were really part of the Web 1.0 story and attracted enormous traffic to the site because they were, this was just part of their mission, and it stayed part of their mission. It was ingrained in the business from a long time. And you think about the journey they took to actually start the company. It took 10 years for them to actually start the company from there, and from there to get to really significant scale. Now they're suddenly growing 150%. Year over year, and they're at a, but it took a long time to put all the ingredients together and get to that stage.
I'd amplify the point about bootstrapping. There's, there is a whole ecosystem, of course, of folks who will invest in smaller and/or earlier stage companies like Rethink, Learn, Reach Capital, but also bootstrapping is just terrific. And being really willing to partner is the other, another element to think about. The more you can find either high net worth or smaller funds or operators that you can partner with, or other companies you can partner with, the better off you're probably going to be in building that ecosystem. We are out of time, but appreciate everybody joining today, and please thank Michael, Phil, and Victor for joining us today.